Good morning, everybody, and welcome to the second installment of the series by Mr. Pat Pattinson on financial distress. In today's episode, we will be focusing on the what, why, and what now about financial distress. Just as a brief introduction, my name is Jaco Durant. I am a junior business rescue practitioner, and I've been working with Pat for almost 5 years now for my sins. Mr. Pat Pattinson, he is a professional turnaround practitioner by designation. He is also a senior business rescue practitioner licensed with the CIPC. He's had his license for as long as business rescue has existed in our South African legal landscape. Furthermore, Mr. Pattinson has had more than 50 substantial implementations of business rescue processes. I've had the pleasure of working with him for about 20 of those, some of them where we actually took co-appointments. So Mr. Pattinson, obviously, as mentioned, senior business rescue practitioner. I've learned more from him, I feel, than I learned in my whole 4 years of my LLB degree. I'm actually also currently busy with my MPhil in insolvency and business rescue, and although that is, extremely helpful, I feel like the practical lessons that I've learned and the time spent with Mr. Pattinson over the past 5 years, it's invaluable in comparison. Take it away, Mr. Pattinson. Please do everybody stick around and ask some questions. Mr. Pattinson will definitely be able to assist in any of those kinds of questions. And I'm very pleased that Pat is here to share his knowledge with us. Thanks, Pat.
Thanks for that, Jaco. Morning, everybody, and welcome to the topic of financial distress, what, why, how, and everything else. So in South African context, we can no longer talk about financial distress without considering the Companies Act. Of course, throughout the world, there has been many definitions, many ways to explain what financial distress is. And again, just for a little bit of context, I've gone to the interweb and have determined or downloaded some of the definitions provided by the various institutions. The first of all is from Investopedia. It says that when revenue or income no longer covers the financial obligations of an individual or an organization. So financial distress is not just limited to companies. It's not just limited to businesses. It can be an individual as well in terms of Investopedia's definition. The Oxford Dictionary gives a very similar definition. It's a condition when a firm where it either cannot meet or has difficulty in meeting its fixed charges. So not just when it's unable to pay its accounts as and when it becomes due, but as soon as it experiences some kind of difficulty. And we'll go into that difficulty in more detail a little bit later on. Wikipedia, a condition where promises to creditors of a company are broken or honored with difficulty, which is in line with Investopedia. So what it means with promises, there is a reasonable, a logical expectation from a supplier that when you place an order with him, that you are able to honor the payment of whatever you are receiving, whether it be goods or services. That is the promise. It is an almost contravention if you place an order knowing that you cannot honor or you cannot pay for those products or services you have asked for. So if we then look at the Companies Act in South Africa, which is going to be the basis of our conversation this morning, the South African Companies Act have broken it up into two parts, and I will read it out for you just so we have no uncertainty about what it says. Section 128F of the Company Act reads, financial distress in reference to a particular company at any particular times means that it appears to be reasonably unlikely that the company will be able to pay all of its debts as and when they become due and payable within the next ensuing 6 months, or it appears to be reasonably likely that the company will become insolvent within the immediate ensuing 6 months. Interestingly here, the Companies Act have broken this definition into two distinct parts. The first referring to the inability to pay, and the second to insolvency. Now, for a company to be in financial distress, it does not have to be insolvent. But again, a little bit more on that just now. The important parts of this definition is reasonably unlikely to pay all creditors, insolvent, and ensuing 6 months. These are the part that normally creates a bit of confusion. So in order for me to explain this, I just want to again bring up the fact that this presentation is my opinion, my views, and it is how I have experienced business rescue and financial distress over the last couple of years. It is not to be used as financial advice, legal advice, or anything else. It is simply my opinion and is not the views of any of the associations or governing bodies that I am a member of. So that's the small print done. When we look at the term ensuing 6 months, the first thing that we pick up is that that term is used in both parts of the definition. Ensuing 6 months is, of course, as soon as a board of directors realize that there might be a situation 6 months down the line where they are not able to pay their debts or where they could become insolvent. Difficult question is, of course, how was I supposed to know? How am I supposed to see into the future? In most instances, becoming financially distressed or insolvent is a very quick thing. It's not something that you can see down the line. But in some instances, by way of example, when you have a company that is a victim of the Pareto principle, where 80% of your income comes from 20% of your clients, sometimes even that could be a single client. You have supplied the client, end of month 1, he doesn't pay, month 2, he doesn't pay, and then you get a notice that this client himself have gone into liquidation and there is no reasonable expectation of that client paying you. You might have some reserves in the bank, but knowing that you have lost one of your bigger clients, you know that that loss of income and the fact that you've not been paid will dilute whatever savings you may have in the business, and that eventually you will run out of money. Yes, we all wait for our ship to come in and we could change things by the hope of getting new clients, getting new money in. But when you look at your business, is it reasonable to expect that you're going to have that additional income within the next 6 months? Or is it more likely that you will be unable to pay your debts as and when they become due in the next ensuing 6 months as a result of this one client that now have defaulted on its payments to you? And that is how you can see 6 months into the future. It could either be that you will become financially distressed, where it will be difficult, or it could be as blatant that you will be insolvent. So let's just look at those two parts next. Reasonably unlikely does not mean it's a factual. It does not mean it's a given. It does not mean it is or has been confirmed. It only has to be reasonably unlikely for you to be in a position to pay your debts as and when they become due. Going back to our example, that client is not going to pay you. You have been in business for 10 or 20 years and you have never secured an alternative client such as that. So what is the reasonably expectation that you will secure the client within the next 6 months to get that additional income? What is more likely for you not to secure a new client or to secure that new client? So you have to look at a matter of probability, and here's where the reasonable person test comes into play. Another person in the same position as you with the same information that you have, how will they see the likelihood of your company becoming financially distressed versus not being financially distressed? Then our second term, and this is also one that becomes critically important and is one of the main aspects when a client comes to us that he believes he was right. The Companies Act does not refer to paying creditors. It refers to all debts. Those debts include but are not limited to your obligations to the receiver of revenue, to your staff, to yourself, to your landlord, your short-term insurance, bank overdraft, everything. In the previous episode, we spoke about zombie companies. So simply being in a position to pay the interest is not sufficient. Can you pay all of the debt? The moment you get a letter of demand, or the moment you realize, I've got one payment I cannot do this month, I've got one payment that I might need to move over to next month, that moment you are already in financial distress. And ladies and gentlemen, I have a lot of clients that says, but the board of directors agreed not to get paid, or we entered into a payment arrangement with supplier A, or we've got a bit of a break from our landlord, a payment holiday from the bank. Those are all examples of inability to pay your debt as and when they become due and payable. Insolvent, when we talk about insolvent, there are two distinct definitions. Just quickly seeing if I put them on here, I don't think so. So we have factual insolvency and commercial insolvency. So factual insolvency, commercial insolvency, there are two distinct parts to that. The one being that you are in a position to pay your debts as and when they become due, by either directors putting money in themselves, additional loans, etc. And although you can pay your debts, you are still in a position where your liabilities exceeds the assets of the business. That means that you might have a total debt of 10 Rand and the assets of the company is only worth 8 Rand. But with a monthly trade, you can pay your expenses, you can look into the overdraft. The other, of course, is when you are unable to pay your debt as and when they become due and payable. The important differentiation here is that your assets might at that point in time exceed or greatly exceed the liabilities of the business. The total debt of the business could be 10 Rand and the assets of the business 20 Rand. But that additional 10 Rand, the solvent part of the 10 Rand, could be tied up in investments, into properties, into loan accounts that are potentially not realizable or not realizable in time. Even if the property is to be sold and you settle all of your debt, it could still take time to sell that property. And that is why they're saying within the next ensuing 6 months. So if you put the property in market, but you're not going to sell it and you're not going to realize the sale and have transfer money in the bank account before you miss that first payment, in theory and in law, in terms of Section 128, and we'll get to 129 just now, you have to actually file for business rescue, notify the creditors, or file for liquidation. And it will then be the task of that liquidator that's appointed or the business rescue practitioner to sell that property. Because the moment you're unable to pay your debts, you are technically in financial distress. And this is what brings us to Section 129.1. And this is where some confusion often comes in. In terms of Section 129.1, if a company is in financial distress, the board of a company may resolve that to place that company into voluntary business rescue. Now, the word may is where the conflict and the confusion sometimes comes in. At boards, there's no, well, we are financially distressed, but we are not going to file. So obviously, they believe that they are doing the right thing. However, you need to then consider Section 129.7, which is the same section, just a little bit further down, that makes it very clear that if a company is in financial distress and the board of directors decide not to go into business rescue, they must file a notice to all of the creditors and affected persons, clearly stating that the company is trading in financial distress circumstances, but that it has decided not to file for business rescue. Now, in my experience, the only time a company decides not to file for business rescue when they are trading in financial distress is because they do not conform to one of the two conditions that requires business rescue. The first is, of course, that the company is in financial distress, easily addressed, easily defined, and easily confirmed. The second part, that is not always so easy, is that there must be a reasonable prospect for the rehabilitation of that business. Sometimes, if that reasonable expectation is not there, the directors know the company is financial distress, but there's no reasonable prospect, and they have to wind the company up or place it into liquidation. The notice is a formal notice from a document that you will download from the CIPC. It is not just a phone call, it's not just an email, it's a formal process, and you need to notify all of your creditors, not just those that you cannot pay. And this is where the reasonable expectation, that promise that we mentioned earlier on, that expectation from a supplier to get paid, is then addressed by this formal notice, and he will know that there is a risk of supplying this company. The difficulty being, once you have submitted this notice to your creditors, I know a lot of people like to call it the suicide notice. You have, of course, committed an act of insolvency in terms of Section 8G of the Insolvency Act. And Section 8G makes it clear that if written notice is given to any one creditor that the company is unable to pay its debt, it has committed an act of insolvency. And it will be very difficult in those circumstances to convince a court not to allow a liquidation application to succeed. So this puts you in a very difficult position. I either go for business rescue or I publish what is referred to, as I said, as a suicide notice. In addition to that, directors of a company must also be aware of Section 2182 of the Companies Act. Section 2182 quite easily reads, any person who contravenes any provision of this act is liable to any other person for any loss or damages suffered by that person as a result of this contravention. So let's go back to Section 129, where it clearly states if you're in financial distress, you may go for business rescue. If you have not gone for business rescue, you must have sent out the notice. So if the board of directors are aware that it is likely for a company to become financially distressed, but they decide not to go for business rescue, and they do not send out that notice, and they do not submit to liquidation, they are contravening the act. They know the company's financial distress. They've not done what the Companies Act specifically requires of them. So they will be liable to any other creditor or any other person who has suffered a loss as a result of that contravention. So how will any person suffer a loss as a result of that contravention? Very simple. If the board of directors finds out today that they are in financial distress, but they purchase something that they know they can't pay, or even if they think they can, it realizes that they can't pay it into the future. If they sent out that notice, that specific supplier might have chosen not to supply them on credit, and therefore they would not have suffered that loss. Similarly, and again, as we spoke to previously about ghost business rescues, once a company goes into business rescue, the creditors can elect not to continue paying for them, not to incur that loss. A landlord could decide to suspend your lease agreement. Creditors could stop paying. All of those additional debts, salaries, rent, SARS, everything that the company then incurs from the moment the board realized they're in financial distress until the eventual liquidation, closure, or then business rescue of the company. That additional debt, the directors could be held liable for. Now, for today's presentation, the professional accountants, we are not going to go into NOCLA, which is a non-compliance of laws and regulation that puts an additional obligation on professional accountants to act once they know that a company is contravening any acts, and obviously trading in financial distress is a contravention of the act, and that places a specific responsibility on all professional accountants as well. Ladies and gentlemen, again, thank you for your time. This is the end of our presentation. Just a reminder, there are several more episodes to come. We will also have an in-person bootcamp. We have received a lot of interest, a lot of proposals on this topic. We will start presenting you guys with where it's going to be and how much it's going to cost within the next couple of weeks. At this point in time, we are just going through all the information that we have received in order for us to choose where exactly we are going to have this presentation or this in-person bootcamp. The next presentation will be next week, Friday, same time, same place. I hope to see you all there. And then from my side, thank you very much for attending.